Good morning, everybody. My name is Steve Scranton. I'm with Washington Trust Bank, and I am going to be your moderator today. Thank you for joining us for the Washington State Capital Gains tax webinar. Our goal is to give you information about what that's all about and what you may need to be doing before filing season comes up. So we've got two speakers for you today. We have Greg Owens, who is a senior financial planner for Washington Trust Bank. And then we've got Rob Blume. Many of you may remember Rob. He was the manager for the director for the wealth management division of Washington Trust Bank for over 30 years. He's now retired and graciously agreed to help provide his CPA expertise on this whole issue. So I want to just cover a couple of housekeeping items. You're all muted, so if you want to be able to ask questions, you should see up on the top of your screen a Q&A feature where you can type in questions, and then I will monitor those and pass those to the speakers, and we'll answer the questions at the end. Unfortunately, I do know that some people have said that if you're using a mobile app like a cell phone or a tablet, you may not see that Q&A option. So I can give you an email address at the end of the presentation that you can send your questions to, and we'll try and get those answered that way. This meeting is being recorded as well, so you should get a notification after the meeting of the recording so that you can be able to share that if you want or review it again. But without any further delay, I want to go ahead and start off with Greg Owens and have Greg give you his feedback, and then we'll turn it over to Rob. Greg, it's all yours.
All right. Good morning, everybody, and thanks for attending this. This has been a kind of a confusing issue for people, and we've talked about it for quite a while, and really didn't think this was going to come good, but it did. So we're going to try to walk you through some of the whys and hows of all of this to hopefully give you enough information to go forward. As part of my job being a financial planner for the bank, we do have clients where we are trying to be tax sensitive in their investments and try to give some kind of guidance about avoiding or delaying tax or using different strategies to try to help out with that problem of a low basis asset. And sometimes we can fix it, sometimes we can't. But at least we can talk through it and make sure we're not doing anything to cause any damage along the way. I wanted to give, first of all, just an overview explanation of what the tax is and a little history of how we got here. The state legislature, they passed this law imposing a 7% capital gain tax on gains that exceed $250,000. It applies to some assets, not all assets. We're going to go through that if we can. It applies to individuals only, so not companies. And they did this in 2021 when people kind of weren't looking because COVID was going on, and it kind of sort of went under the radar a bit. But immediately there was a lawsuit filed, as you can imagine, because we cannot have income tax in Washington State by our Constitution. And everybody, this looked and smelled like an income tax, so we couldn't let that stand. So a lawsuit was filed last year in Douglas County, and the law was invalidated by the trial court. And most people thought rightly so. Then a few weeks ago, the state appealed it to the state Supreme Court. And in a 7-2 decision, the state Supreme Court said, no, this is not an income tax, it's an excise tax. And it's an excise tax on the right or privilege of selling an asset. And let everybody just try to digest that for a second. Excise taxes we can have here. Obviously, you pay a real estate excise tax when you sell a property. And that was increased a few years ago. For those that remember, it's now a scaled tax that goes up the more the property is worth when you sell it. So good thing, properties are excluded from this tax, probably because they know they're going to get you on that tax. The reasons for doing this are the proceeds are supposed to go for funding education and building schools. And they believe that this tax is only going to affect around 7,000 families and individuals. They think it's going to raise over 500 billion a year, or 500 million a year. And I think with what we've heard from clients, there's going to be some aggressive avoidance of this tax, up to and including moving out of the state. So we'll talk about that as well. If that does happen, I don't know how they're going to get this revenue that they think they're going to get. But anyway, the other reason for doing this, and I read both in a couple of different articles, and also it's right in the Revised Code of Washington, where the law exists. One of the reasons for doing this was that Washington's tax system is the most regressive in the country, meaning that the lowest income people pay the highest share of their income in tax burden. And it's because we don't have an income tax. And if we did, it would be a little bit more progressive because we'd pay these higher rates the higher your income goes. And this has been a long-standing problem in this state, that some people perceive that as a big problem, and they want to try to fix it and undo it. It says right in the revised code that middle-income families in Washington pay 2 to 4 times more in taxes as a percentage of household income as compared to the top earners in the state. And low-income Washingtonians pay at least 6 times more than do our wealthiest residents. That's verbatim. So clearly the reason behind this was to try to fix that problem. And so obviously at our bank, and especially in our wealth management division, we have people that are in that wealthiest group that are going to now be picking up this tax bill. They were also very clever in drafting this law because they made it referendum proof. So one reason why you haven't seen petitions hitting the street to try to get a measure on the ballot to undo this law is because you can't. And I haven't read the actual language that says you can't undo it, but apparently you can't. And I read a couple of different articles from law firms that stated that. So I've been asked this already. Is there any way to fix this, undo this? Can we sue? We're going to be looking at a lot of different options from various, following various cases and lawsuits if they get filed. And we'll try to stay on top of that and let our clients know. Another question I got asked recently, and of course, I'm always keen to try to incorporate taxes in my modeling and so forth. Someone asked, well, shouldn't I be able to deduct this tax from my federal tax? And this would probably be deemed under the SALT tax, the state and local taxes, where we now have currently a limit of $10,000 per year that you can deduct. So this is your property tax, your sales tax. In Oregon and Idaho, income taxes you can deduct on your federal. The problem is they limit it to $10,000 a year, which, I mean, if you have an expensive property, your property taxes are more than that anyway. So whatever tax you paid in cap gains tax to the state should be deductible, but it's going to be limited currently. Now that does sunset in the future, and we'll go back to being able to deduct whatever your state and local taxes are. So that'll be a help. Now for the actual mechanics of how this gets filed and charged, we're going to have Rob Blume walk us through, since he actually prepares returns, he's going to take us through the step-by-step and how this applies and how you actually have to file it, which is an interesting story in itself. So take it away, Rob.
Well, thank you, Greg, for kind of leading that discussion. And I'll kind of preface this to say that this is brand new to a lot of us. So this isn't necessarily a legal presentation. It's a presentation of our observations, because as we know, a lot of the legal activity with this will be how it's implemented, and it hasn't been implemented before. So just kind of give you that caution. And one thing also, that our presentation today will be talking a lot about the law as it exists. And if you had any capital gains in 2022 exceeding 200, long-term capital gains exceeding $250,000, you're screwed. There's no planning around that too much. If you're an individual Washington resident and had a $500,000 long-term capital gain of stocks or bonds or other tangible personal property last year, you're going to end up paying 7% to the state of Washington for the gain in excess of $250,000. And there's a couple other deductions that you can take. But again, there's not a lot of planning around last year. What we want to talk about is a bit about the law, and then you can reach out later to your relationship manager or to Greg, who can discuss a little bit more about the planning opportunities that exist. And they do exist. Some of them are a little harsh. To avoid a 7% state tax, many people may not want to move out of the state of Washington, but again, that may be a viable option for some folks. There are other things you can do with charitable planning, a charitable remainder trust, which Greg will talk about later, converting a S Corp to a C Corp, a few things like that that are opportunities for this year and going forward. In 2022, we're stuck. So let's go on to, again, a couple things. One is that like Greg said, this is a tax on income, and 41 states and the Internal Revenue Service do not recognize long-term capital gains as income. For whatever reason, the state of Washington doesn't look at it that way, and we're able to convince 7 Supreme Court justices that this is not necessarily an income tax. I beg to disagree, but again, like Greg said, we're kind of stuck with what we've got. So it's 7% on individuals, not corporations, but it does include pass-through entities like an LLC, a general partnership, limited partnership, and S corporation. Those are pass-through entities. So if you had a gain within one of those and that gain gets transferred to you as an individual and it exceeds $250,000, you are going to have to pay a tax. If, let's say that you have a partnership and there was a gain last year of $300,000 and there are 2 partners and you're each equal 50% partners, you each have a $150,000 gain that is reported to you. Neither of you are qualified for that $250,000 limit. So that's one important thing to kind of keep in mind. And again, in planning, sometimes there's going to be opportunities to establish perhaps a family limited partnership going forward. If you anticipate having gains like that, there may be ways to eliminate or mitigate that type of tax going forward. So remember that this is an individual tax, but a disregarded entity or a pass-through entity, you're going to get the income and the capital gain on your tax return. And that kind of drives what's going to happen with the state of Washington. So a couple points. One, this is a long-term property, so you have to own it more than 1 year. And it's intangible personal property, stocks or bonds, collectible assets, artwork, for example. Cryptocurrency is something else that if you held it for more than a year, you're going to have to pay tax on it if the gain is greater than $250,000. But what is not included? Real estate, not included. Retirement accounts, not included. Livestock, not included. Depreciable assets used in a trade or business, that gain is not included. Timber, And I'd like to know who did the lobbying on this piece, but goodwill from the sale of a franchised auto dealership also does not qualify for this tax. Again, how that snuck through in our state is kind of a mystery, because I'm sure it doesn't apply to a lot of people, but when it does apply, it applies in a big way. And a couple of things also that this doesn't include, and these are very important points. One is if you had an installment sale prior to January 1st of 2022, and last year your installment gain exceeded $250,000, you do not have to report that, providing the sale that created that installment gain occurred prior to January 1st of 2022. That may be, again, a big thing for a handful of people, but that's important to know that if the sale occurred prior to last year, regardless of the fact that you may have had a $250,000 gain in 2022, you do not need to pay a tax on that. Short-term capital gains are not subject to Washington tax. So that's another important distinction, that if you sold it 2 days prior to holding it for a year, that does not qualify. The catch with that, of course, is that the IRS considers that ordinary income, so you're going to pay more tax to the federal government. But important to know that. And also, I think this is an extremely important point that may get lost, is your short-term gains or your short-term losses on your federal tax return, your Schedule D, do not offset the long-term gains for reporting to the state of Washington. So if you look at your 1040, your Schedule D, and you had $300,000 of short-term losses last year and $500,000 of long-term gains, in your mind, you may say, well, the net is I lost $100,000. Is that right? Yep. However, the IRS or the state of Washington disregards that short-term loss. They're only looking at the long-term gain. So that's very important, that you cannot offset your long-term gains with your short-term losses. Also, day traders typically would not have to worry about this because only gains that are long-term apply. So again, there are some very important things to keep in mind. And sadly, the law was passed, the Supreme Court acted just a few weeks ago, and your returns are due the 18th of April. So not a lot of time to consider some of these things, but I think it's very important that you're aware of a couple of those distinctions. So again, what does this include? It includes stocks, bonds, collectibles, cryptocurrency, should you have that long-term gains with that, and other intangible personal property. And it has to be, if it's collectibles, for example, let's talk about that. Again, artwork has to be property located in the state of Washington at the time of sale. So last year, if you had art or collectible cars, for example, in the state of Washington in March, and you sold it, okay, that's going to be subject to the tax now if the gain exceeded $250,000. But it's also interesting to note that if the property is located in Washington in the same year, even though let's say that you had it last year and you transferred it to Arizona to sell the property, that's still a Washington sale. It was located in the state of Washington in the year of sale or the year before. So let's just kind of look at 2023. You have a Shelby Cobra 500 that is worth $1 million. It's been in the garage for 20 years. You paid $3,000 for it, so you have a $997,000 gain. And this year, December 20th, you send it down to Arizona to be sold. Tough luck. That was part of the property in the state of Washington during this year, so you are not going to avoid the gain, even though you transferred the property out of state. So again, Washington has kind of figured out that a couple of things might occur. So if the property is located in Washington in the same year or the year before the sale occurred, you're going to be stuck paying the tax. You also have to be a Washington resident at the time of the sale, and the sale is not subject to another jurisdiction. So California or somebody else isn't going to count it as a sale. So a couple of things, again, to be kind of aware of. And for you, what is a Washington resident? A Washington resident is somebody domiciled in the state of Washington. Prior to this law, people would try to avoid being a California resident or an Idaho resident because we had no income tax. But a Washington resident is somebody that is domiciled in the state of Washington for at least 183 days. So keep that in mind as well. It's 183 days makes you, again, domiciled in the state of Washington. So those are some general principles. And again, Greg and your relationship manager at Washington Trust Bank are going to able to help you kind of navigate what 2023 and the future will look like. But 2022, we're stuck with what we've got. So let's kind of look at how is that gain computed. So we say it's a $250,000 limit for your gain. Anything more than that is taxed. So you get a deduction for $250,000. So let's say your gain is $300,000. You're not paying 7% of $300,000. You're paying 7% on the amount over that $250,000. So you'll only be taxed only, it's a poor expression, but only taxed on the $50,000 that exceeds that $250,000. The state calls it a standard deduction. So we'll start with that. And after that, there are a couple of provisions where it doesn't apply. One is that it's a qualified family-owned small business. If you sell that, it's not subject to the tax. And without going into a lot of detail over what is a family-owned small business, a couple of things. One, you have to have owned it for at least 5 years, and your family or you had to materially participate for at least 5 of the last 10 years. So own it 5, be active in the management for 5 out of the last 10 years. Revenues under $10 million for last year. So it doesn't apply to large businesses, but small businesses with no more than $10 million of revenues, and at least 50% owned by your family. That's one exclusion for the gains. You also have the ability to deduct charitable contributions up to $100,000, but there's a catch with that as well. I was like, that's what keeps Greg and I employed. I think there is always a catch. And the catch with this is that it has to be the charity, the funds have to be directed or managed in the state of Washington. So you give your $100,000 gift to the University of Texas, that does not qualify as a deduction for the purpose of computing this gain. So be aware that there is a deduction for up to $100,000 of charitable contributions, but it has to be managed or directed in the state of Washington. And right now, again, like I mentioned, we don't have a lot of interpretations of this law. So if, for example, in Spokane, if you gave $100,000 to a Novia Foundation, a plan and set up the Blume family gift for $100,000 at a Novia, it's the assets, the gift is typically in Spokane, but what if later on I direct these funds to be used at the University of Idaho? Okay, I'm not sure if what the state of Washington is going to think about a directed gift like that. So there is some ambiguity around this, and I would again be a little bit anxious about what that's going to look like going forward. So $100,000 charitable gift, providing the funds are going to be directed or managed in the state of Washington. You also get credit for capital gains tax paid to another taxing jurisdiction to the extent the gains are included in the state of Washington. So for example, for some reason, if you get stuck paying California tax on a gain and you're a Washington resident, you can have that, you get credit for the tax paid to the state of California. Again, that's a very rare instance, but that's another credit that the state provides. So that's a little bit of the some of the principles to keep in mind. But in the filing process, I'll tell you is the state has scrambled to get ready for this, the April 18th filing date. So they have, I think, for the state of Washington, a very good website and a couple video tutorials about how to set it up. But the sad thing is that something that you can't just print something, fill it out, send it off to the state. They want you to register for a capital gains tax account. And it's through the Department of Revenue. And there's something called the Secure Access Washington. SAW is how they want you to access to pay the tax. So you have to go in, either you can establish an account or your CPA or accountant can establish that account. They may have an account already established and do the filing for you. So they can file, and it's fairly straightforward. I've gone through the process and it's straightforward, but not necessarily fast. So don't try to do this on the 18th after 2 drinks at 7 p.m. in the evening. May not work to your advantage to be trying it at that point. But again, there's some videos at the website and they can show how to do this, but you do have to register for a capital gains account. And then after you're registered, you can file the capital gains report. Fairly straightforward, where you have to report each individual gain. I think for many taxpayers, they may not detail all the securities that they sell. They may just refer to a Washington Trust Bank custodial account, and here's what I sold, here's my gain. The way the state of Washington's website works through is that they want it identified security by security. That's not what they ask for. I really doubt they're going to get that for many taxpayers, just because of the complexity in doing that filing. The state of Washington is really interested in the revenue. I don't think as much the going through all the detail, but anyway, they do request that. The due date is April 18th. So it's just a little more than a week away. And if you don't pay on time, the interest rate is, there's a 3% statutory interest rate that they'll charge. It's prorated by month, and a 7% penalty. So keep that in mind. If you don't, and the penalty is applied if you don't apply for an extension. The 3% rate is charged on whatever you may owe. So if you don't pay until next October, you're going to have 3% prorated by month until you pay in October. If you don't file an extension, it's 7% plus the 3% prorated by month. So it pays to make sure that you're at least filing the extension if you're not prepared to pay or aren't sure about the amount. And also when you file, and Greg and I have talked about this a bit, is that you have to provide your federal tax return when you file with the state of Washington. And as many of you know, if you file in Oregon or Idaho, there is an agreement with the federal government where the state has access to that information. But you file with the federal government. If you're audited by the federal government, frequently it may take a year or two, but the state of Oregon or state of Idaho is going to find out that you were audited and ask you, if you end up paying more to the IRS, perhaps to pay more to them as well. I don't think that exists with the state of Washington, and we're really not sure why the state has the right to obtain your tax return, but they do ask for it. And you can file when you do set up the capital gain tax payment or tax form with the state of Washington. You can download your tax return. So I think for a lot of people, if you have a hard copy, that's going to be a nuisance. Hopefully your CPA or your accountant can file for you, where they can attach a PDF version. And if it's multiple files, you can send each file separately, or again, you can file a hard copy with them. if you want. You do have to print a voucher from the state's website and attach it to the return if you're going to file a hard copy. So a bit of a cumbersome process, but that's another obligation. If you want to file an extension, there's a couple ways to go about doing that. You can file separately with the state of Washington requesting an extension to file, or if you file with the IRS to extend your return to October 15th, that qualifies to be filing an extension for the state of Washington as well. You do have to provide, once again, there's always a catch, provide to the state of Washington the confirmation number or other satisfactory evidence, that's their term, satisfactory evidence of filing the extension. So again, a couple of glitches with that. And it's also interesting, that extends the time to pay extends the time to file with the state of Washington. It does not extend the time to pay. So again, that 3% interest will continue to accrue until you pay. So if you file your federal return on time, it may benefit you, if you're worried about the state, to file an extension regardless with the federal government, so that you have until October 15th to deal with the state of Washington. The state of Washington just asked for that extension. It doesn't say that they want their money when you file your federal return. They say when the federal return is due, which again is on October 15th. So if you're scrambling around and really don't feel you want to deal with it, and you may not have a very big liability or any liability at all, file that federal extension, and that gives you time until October to deal with the state of Washington. Once again, that does not extend the time to pay. It just extends the time to file with them. And if you do owe the state of Washington money, it cannot be by check. You cannot pay them by check unless they've granted you an exemption to pay by check. So kind of a nuisance there. You can pay ACH debit, and you can contact your bank if you want to pay via ACH credit. But typically, again, it's an ACH debit. You can also pay credit card or a debit card. However, the state of Washington is going to charge you 2.5% of what you pay, in addition to the tax you're paying already, if you do use a credit or a debit card. So, and if you have a CPA or accountant that files the return for you, you can go ahead and pay separately. You don't have to give them authority to pay. You can pay separately, and the state has set up the website effectively that you can refer to what's been filed when you make that payment. Again, a couple catches, and do not wait until April 18th if you're going to send a check, because you have to get an exemption from them to pay with a check. So again, a few nuisances, and once again, it's a 3% interest rate on what isn't paid, and a 7% of the tax penalty if you don't file timely. So again, the IRS, we don't think they're sharing information with Washington, but you do have to send your federal return along with your your capital gain report to the state of Washington. So keep that in mind. And you're not required to file if your capital gains are less than $250,000. I do think if your gain exceeds $250,000, and you do have a qualified charitable deduction that will reduce your net gain below $250,000, it probably pays to go ahead and file. You're not going to pay anything, but it may save a problem a year or two down the road if for some reason the state finds out that you had gains in excess of $250,000. So we have Greg and I have a friend who works, he's a lawyer that works in employee benefits. And his comment to me was always about, in the employment benefit area, that there was an ocean of non-compliance. And we kind of feel the same way with this, that there probably is going to be a lot of non-compliance. And I'm not sure of how the state is going to fully manage this as far as the compliance piece goes. but we're certainly not recommending you try to avoid what the law, how the law is stated. But there are opportunities to kind of plan going forward. And that's, I think, what we want to give you is a little bit of substance about how this applies to 2022, but also opening the door for more planning opportunities for 2023 and going forward. Now I guess we have questions, or Greg, if you want to fill any details that I may have omitted or.
No, Rob, that was awesome. I did have one quick question that I know is probably going to get asked. What about properties that are sold or assets that are sold in a trust, an irrevocable non-grantor trust?
And that's a great question, Greg. And that's not an individual. As long as the gains are held in the trust, it should not be subject to Washington law. However, if it's a trust where for some reason the gains are distributed to the individual and the individual gets a K1 with long-term capital gains exceeding $250,000, then they're going to be subject to that tax, which is, again, interesting to do a little bit more planning with that trust to perhaps retain the capital gain within the trust rather than distribute it.
Sounds good. And I do have one other example question. If I have an S Corp that I own half and half with my brother, and we own a property, and we want to sell that property, and it's got a large gain in it, how best would we do that?
Okay, and begin with, that's a good, it's kind of an interesting point. And I'm sure it's fairly, I bet it'll be fairly typical going forward, because the real estate itself, you sell the real estate in the S corporation, the gain gets distributed, and it's not going to be subject to tax. However, now you have an S corp that is worth a lot more. That you have that gain retained in the S corp, so you think you're going to sell the stock or distribute the stock out of the S corp, and the gain is going to exceed $250,000. So I think that's a challenge, and maybe again this is is uncharted territory, but perhaps liquidating that S corporation over a period of years rather than in 1 year liquidating and saying that they sold their stock with a low basis and had this gain exceeding $250,000. So again, uncharted waters, but I think that is definitely an area to do some planning. If you can structure those gains, the same thing, Greg, along the same lines, let's say that you have a $1 million, you have $1 million built-in gain. Or no, I'll make it easier on me. A $300,000 built-in gain. You sell the stock this year, you're going to get stuck paying that tax on this, on the 50 grand, the 70,000, the $50,000 exceeding 250. Why don't you spread it out? If that's all the gain you have, it's a long-term capital gain. Sell 200,000 this year with a $200,000 gain, 100,000 next year. You've avoided the state of Washington tax, and you can do it December 31st and January 3rd. So not a bad way to, again, do a little bit of planning to avoid that tax, and it's again not necessarily that hard to do. And I think there's another interesting thing to consider too, and I don't necessarily have the answer, but it's by individual. So let's say that you have a couple that are married filing separately. Okay, my gain may be $300,000. My spouse's gain may be $100,000. The way the law works right now is that it doesn't imply that you need to add that gain. You don't need to. My wife with $100,000 gain should avoid having to pay tax on her part. I have to pay on my 300 grand. She should not have to pay on her 100,000 separately. So that's, again, kind of an interesting distinction to make. And you don't have, if you file married filing separately 1 year, it doesn't mean you have to do it married filing separately next year as well. There are some federal tax penalties for doing that. But again, it might be some planning to consider for some folks to help minimize that potential tax to the state of Washington.
So we've got quite a few questions, so let me jump in and see if we can answer some of the audience questions. And for the audience, I apologize. The features of the Microsoft Teams live event is we can only have one person on camera at a time. So you'll hear either Greg or Rob, but you're only going to see Rob because everybody loves David Letterman.
I do.
Excellent.
So Rob, your first question.
3 years that I've worn a tie, Steve, so I want credit for that.
So your first question, because you answered Greg's question about specific type of trust, the question is, does the exemption apply to all types of trusts?
No, and that's a good question, Steve. But if it's a grantor type trust, so you've established it during your lifetime for estate planning purposes primarily, like the Rob and Randy Living Trust, it's a grantor trust that we control during our lifetime. It's going to be included in our estates at our passing. And the way that grantor trust works is all the activity flows through to our personal return. So a grantor trust does not avoid that tax aspect. But so that's one that doesn't. A simple trust where, for example, a marital trust where the surviving spouse is entitled to the ordinary income, interest and dividends every year, typically the capital gains are not going to flow out to that surviving spouse. So once again, those gains are not going to get taxed by the state of Washington. So those are two examples. If it's a complex irrevocable trust where, let's say it's worth $1 million and there was a sale of stock that generated a $500,000 capital gain, and prior to the end of the year, you distributed $980,000 to the beneficiary. Theoretically, you've distributed that capital gain to the beneficiary, so very likely they're going to get stuck with the state of Washington tax. I think that kind of falls under the oceans of non-compliance because it's going to be very difficult for the state of Washington to detect that, and not every trustee is going to say we distributed the gain, regardless of how much cash was distributed. So grantor trust does not provide any protection. And Greg, maybe you can jump in with this. How about a charitable remainder unit trust? What would that provide?
Yeah, and it's a technique that I already like anyway, and I usually try to talk about at some point. If a client has at least some charitable intentions, there's a strategy. If I haven't gone over with you, I would love to at some point. But you contribute property or an asset to the trust, and you're saying that the remainder of the trust, after you pass or after a term of years, it's going to charity. So it's a charitable entity that is going to pay you an amount of money each year over your lifetime or that term of years. And then you're giving up the ultimate right to that asset down the road. So it's a charitable entity, a trust that's for charity that can sell that asset tax-free, basically. But the payments that come out to you each year are taxable to you, and they're taxed in a certain order, the worst first, basically. So ordinary income, then short gains, then long gains, and then return of principal. So if you can structure it so that the payment coming out to you, the capital gain portion of the payment is under $250,000, this is how I understand it anyway, then you will not pay the Washington portion of tax on any of the payment that comes out to you.
Yeah.
So it can be a way to delay tax and spread tax out, get a charitable deduction up front that can be used against another sale of stock. And it can be it's like a good, well-rounded plan for everybody, for the family, for charity, and for you.
And that's a great idea, Greg, not only to help kind of, defer and minimize the long-term capital gain, but also, like you said, if it's somebody that does have a large gain this year, a component of a charitable remainder unit trust when you fund it is the charitable deduction. And let's say that you name Washington Trust Bank as the trustee, so it's managed in the state of Washington, and the charitable beneficiary is Gonzaga University in Spokane, Washington. So there's no question the funds are managed here, they're going to be used in Washington, so you can get a deduction to perhaps offset any other long-term capital gains this year, in addition to providing that kind of an installment sale going forward to minimize the long-term capital gains and diversify your portfolio. So that may be a great idea for people to bring up with Greg later on to discuss.
Okay. The next question, I think I heard you say depreciable assets are not included, but they wanted to confirm, does a calculation of capital gains include depreciation?
It kind of does and kind of doesn't. You know, part of it you're going to recapture as ordinary income depreciation that you've taken, but very seldom I think you're going to encounter that, because real estate, again, does not qualify for this tax. So that's where a lot of depreciation comes in. And if the assets were used in a trade or business, computers, office furniture, variety of things like that, they do not qualify for this either. There are some things, and I really don't have an answer. If you sold an elevator, for example, that you're separating from trade and business, and you're separating from the real estate, that perhaps would be subject to long-term capital gains. But that, again, is an area that is a little bit vague, and it is fairly complex when you get into that. But most people should not have to worry about the depreciation, because it doesn't apply to real estate, nor does it apply to a trade or business.
Okay. And then another wanted to confirm that the 250,000 is for the total sales for the year, or is it on each transaction?
Total.
Okay.
Total long-term sales.
Right. And then a question, they wanted to know, can you use long-term capital loss carry forward from 2021 to offset the gain in 2022?
And this is just my assumption, but I doubt it, because you're not using long-term gains from installment sales that occurred prior to January 1st, 2022. So my bet is that you're not going to be able to offset the losses. They're looking at actual transactions during the course of the year. So the fact that you may be carrying forward a loss from the prior year, I doubt very much that that's going to offset a gain recognized and realized in 2022.
And then a couple that are related to, if they live outside of Washington, they're domiciled outside of Washington, but their sale or their business was in Washington, is that subject to the 250,000 capital gains?
I would think it would be. You get if you were an Idaho resident, sold your Washington company, sold the stock in the Washington company, and it's not a small business as defined by the state of Washington, you're paying tax in Idaho because you're a resident there. So you get credit to offset what you're stuck with paying in the state of Washington. But I think just because it was domiciled here, the stock was here, I could see Washington reaching out for that. But again, I think that's a very gray area. Greg, I don't know how you would see that.
Yeah, I think, you know, if you said, well, it's a stock in my business, just as it would be stock of Microsoft, and if I don't live here, then how are you going to tax that? But if the actual business is a physical business that is located in, you know, downtown Seattle or something, I could see them trying to get it, and this is going to be an area that'll probably get tested.
Yeah, and perhaps again some planning around that. How do you avoid that? But again, that there's a couple of gray areas like that, Steve, that we'll punt, but we don't have, you know, real strong, firm answers on what it's going to look like quite yet. Okay.
Well, here's more of a specific example that maybe you can get feedback on. They're saying that if they have a 100% owned C Corp in 2022 that sold $1 million in real estate, 500,000, I guess these are the gains, $1 million for real estate, 500,000 for an operating LLC, and 500,000 for a holding LLC. Are these subject to that capital gain since it's in the C Corp?
If it's in a C Corp, no, the corporation is going to be paying income tax on all of that. But remember, this is a tax on individuals only. So a C Corp, no problem. S Corp, where the gains, flow out to the shareholder, different story. C Corp's bad enough, it's paying the tax already. So it's got that burden to begin with the IRS.
Yeah. And then would deferred stock-based compensation be subject to this long-term capital gains tax when the distribution event occurs?
They should be paying tax, depends on the type of deferred compensation it is, but they're maybe paying tax on it to begin with, and they're paying income tax either on the distribution or as it accretes. If they get RDU stock this year, for example, the company Marriott issues some stock to an individual, and it's the compensation to them is $100,000. The basis is $100,000, and they sell it in 2 years for $500,000. They're going to get taxed on the difference between what that basis is and when they actually sell it. So it's not, it's again kind of a burden because they're paying tax at ordinary rates already when it's distributed to them, when it's vested, but they are going to be taxed on the capital gain should they sell, and there's appreciation in excess of that $250,000.
Okay.
Yeah, if I could jump in,
Yeah.
like we have many clients that are paid in part or most of their compensation is RSUs, restricted stock units. And when they vest every couple of years, that's actually W-2 income to them. So they're paying full boat on the value of those shares. If they keep the shares, I guess what Rob's saying, if they keep the shares for 5 years and there's even more gain, then yes, that gain is long-term gain. But the day they vest and they're taxed on them, if they sell those shares, there wouldn't be any Washington tax to pay.
Okay. A question of basically, how does the state know when you have these type of sales? Is there an equivalent 1099-B, or how would they know that you accrued this $250,000 or capital gain in excess of $250,000?
They're relying on you to be honest. Maybe at some point the IRS will share that information, but for right now, it is they have no way of investigating that. They do not get a copy from the brokerage firms of that 1099-B of the gross proceeds that were reported to the individual. They do not have access to that yet. So really, for right now, it's taxpayer honesty. I don't see it any different, Greg. I don't know if you.
No, it's the honor system.
Yeah. Self-reporting.
Here's another specific one. I'm just gonna have to read it because it's beyond my specifics. It says, if you have a suspended loss carry forward due to the basis or other limitations, not an LTCL, that in 2022 created a recapture scenario because an LLC was converted to a C Corp as a phantom long-term capital gain recognition to begin with, would the long-term capital gain rules apply? Hope you understood that.
If they're reported on their Schedule D, if they're required, if that's flowing through to them on their Schedule D as a long-term capital gain, I don't think there's a way to avoid it. Again, that's a fairly complex and fairly unique situation, but when it happens in a big way. But I don't think they're going to avoid having to pay the state of Washington tax on that.
Okay. And then another question similar to the other one, but this is saying that if in 2021 you had a long-term stock capital gain loss for $100,000, and in 2022 you have a $500,000 long-term gain, what would your capital gains, or would that be applied against it? I guess it sounds like.
I think you're stuck with that $500,000 gain this year. It occurred 2022. And once again, my theory on that is you don't have to pay tax on gains that occurred prior to 2022, even if you're reporting on the installment basis. So it makes sense that you don't get credit for the losses that occurred prior to 2022 either. The law reads gains realized and recognized during the calendar year, long-term gains. So I think good idea, but I really don't think you're going to be able to offset that gain with prior year's losses.
Yeah.
Again,
On the federal side, you could.
Yeah.
Though.
Yeah, federal, no problem. But state, I do not think that applies. But again, there hasn't been any case law. And I'll tell you too, the state, I called them this morning to ask a couple questions. They're as mystified by this as I think we are. So it's, again, subject to interpretation. But again, that's kind of my our theory about how that's going to work.
Okay. Somebody just wanted to make sure they understood that for somebody filing a joint return, it's still 250,000, not 500,000, right?
That's correct.
Okay. And then maybe a more simple one that you might know, Rob, they said that they set up an account with the Department of Revenue, but they don't see a way to allow the CPA access. Do you know how you do this?
The CPA has to set up their own account. You don't transfer to the CPA. You can tell them you have an account, but the CPA should have their own account that they can access using your social security number and some other identifiers. But, and I think that would be the way to do it. Tell your CPA that you've set up your account and this is what to do. And they could log into your account using your credentials. So that'd be a way for them to get access to it.
Okay. And then I know you guys aren't lawyers, but if you had any opinion, it says the U.S. Supreme Court usually does not hear cases unless there is a difference between jurisdictions. Any chance they might hear a case based on equal justice?
That I don't know. They went through some of the constitutional issues when they heard this case. And the reason it went to the Supreme Court is because they had a constitutional issue, a fundamental issue as to what this should be called, whether this is a tax on property and property is supposed to be taxed equally among all people. And so that's what they challenged it on. And they said, this isn't a tax on property. This is a tax on the right or privilege to sell an asset. So I don't see anything further.
Okay. We have one last question. I know we're coming right up on 11 o'clock, but see if either of you have an opinion. City of Seattle is now discussing its own capital gains tax. Either of you think that the city has traction on being able to get away with that?
I'll leave it
I
to
did
the
read
resident
that.
of Seattle to answer that one.
I did just read that yesterday, and initially they kind of alerted everybody and said, City Council's going to enact their own cap gain tax. But then when you read further in the article, it said that they're considering many different taxes to try to raise funds to fix the myriad of problems that we have. The cap gain tax possibly being one of them, but I think they're going to run into the same hurdles. If it goes to the Supreme Court, then I guess maybe they could do it. If they really want to drive people out of the city over to Bellevue, then fine, do it. They're already halfway there anyway.
Yeah. Okay, we are at 11 o'clock. I wanted to thank everybody for joining this webinar. I think there was great information shared by both Greg and Rob. As I said at the beginning, it has been recorded, and you should receive a copy of that recording once it's been processed. And we will also probably mail that recording out to people who are not able to attend. So if you have anybody that wanted the information but wasn't able to attend, let your relationship manager know, and then we can get that recording sent to them. We just want to thank everybody for joining us. Rob, Greg, thanks very much. Great job done there. And
thank you.
Let everybody move on to the rest of the day. Thanks, everyone.
Thank you. Bye-bye.
Bye-bye.